Good afternoon, everyone. Once again, it's a great pleasure to invite you all here for the 5th session of Commerce 101. As you all know, Commerce 101 is a project which includes workshops and seminar series organized by the Students Association of Commerce of the Department of Commerce and Financial Management. With the intention of continuous development of commerce undergraduates, today we are stepping into the session 1.4 Current Monetary Policy Operations during the COVID-19 pandemic in Sri Lanka. Our resource person for the day is Dr. PKG Harischandra, Additional Director of Economic Research of the Central Bank of Sri Lanka. As well, he is overseeing the work relating to areas of money and banking and public finance. He is a member of Monetary Policy Committee of the Central Bank, and further, Dr. Harischandra works as the chair of the Research Advisory Committee of the Economic Research Department, as the editor of Staff Studies Journal of the Central Bank. The most important thing about Dr. Harischandra is he has published research articles in international and local journals on the areas of monetary policy, inflation persistence, exchange rate regimes, business cycles, financial system stability indicators, and etc. As well, he has authored articles for local periodicals on various themes. Today, our guest of honor, Dr. PKG Harischandra, the floor is.
Thank you very much for the kind introduction. I assume you can hear me clearly, right? No issue with the sound and all, right?
Yes.
Of course, sir, we can hear you.
Loud and clear. Okay, good. Then again, I also want to thank Dr. Sunetrani Amartunga for inviting the central bank to share some thoughts on the current monetary policy operations, particularly given the challenges that we are facing during the pandemic. This is very timely topic, and a lot of things are happening at the moment. As Dr. Amathunga sort of mentioned, very busy days for everybody, and yeah, the challenges lie ahead because of the pandemic-induced sort of effects, as well as the sort of structural or long-standing issues that the economy has been facing for years. Yeah, thanking again, and also it's good to be talking to you all, the MSc students who have done some basic monetary policy, I think, theoretical aspects in the taught module, and it's always good to have this practical flavor of how the policy is made and how it is implemented. So, so I have a presentation to share with you. Let me share my screen so that I can show you the.
You are allowed to share the presentation, sir.
Thank you so much. Yeah. I hope it is visible now.
Yes, sir, it's visible to us.
Okay, thank you. Right, so we have a good 2-hour period. I think we can discuss quite a lot of things during that time. And everything that I discuss here, all the views expressed by me during this 2-hour session are my own, and they do not necessarily represent the Central Bank of Sri Lanka's views. That's the general disclaimer that we have in every presentations we do. And you can disturb me anytime if it is if things that I say not clear or you need any clarifications as we move along. The outline for today's presentation is this. Yeah, I mean, your broad theme is the current monetary policy operations of the central bank, but I thought of having some background to the monetary policy making. Thought that would be useful for you all. So I'll basically start with what do central banks do in general, and then I will come to what does monetary policy do, and then I'll come to monetary policy making and how it is implemented at the central bank, with some background information with regard to the monetary policy framework that we are working with and the instruments or the tools available for us in making monetary policy at the central bank, and what's the impact so far that we can see of the monetary policy measures that we have been implementing during this pandemic period. So if I go to the first point, what do central banks do? So I have some couple of some charts to show you to begin with. These are four key macroeconomic variables in the Sri Lankan context, starting from 1951 in most cases. And they are the real GDP growth rate and the inflation series, inflation rates, the Colombo Consumer Price Index-based inflation, and the interest rate of treasury bill rate of 91 day, 3 months T-bill rate, and the level of the exchange rate, LKR, against the dollar. So what we can see here is that there is significant volatility in macroeconomic variables. So in the GDP context, lots of ups and downs during this period. And in some periods, the deviations are quite large. And in some periods, deviations are not that large. If you take inflation chart, that's quite similar story. We have very big fluctuations in inflation rates over time. And in some periods, we have seen over 25% of inflation. And in some periods, very low inflation, near zero. If you take the treasury bill rate, quite similar, not that volatile compared to GDP and inflation series, but still there is significant volatility. And the LKR USD rate also trending upward in general, which shows a depreciation over time. But if we take the growth rate of this series, there are quite a lot increases, so ups and downs in the series. So one thing that we can see is that there is significant volatility in macroeconomic variables. And then the question arises is, what do we prefer? Like if you take the economic agents like consumers or producers or institutions like government or private corporates, banks, and there are divergent preferences on these macro variables. If you ask from a consumer, and they would definitely say with regard to inflation, they would prefer lower inflation. Or sometimes as consumers, we prefer even a deflation, which means prices going down. But if you ask a producer, he would prefer a better profit margin for their goods, or maybe keeping their cost of production at a certain level, but would prefer a higher price so that they can earn a good profit. If you ask an employee about the wages, and they will definitely say we would prefer a high salary or high wages. But if you ask a company or a business, and they would definitely prefer a low cost for their labor. And again, if you ask from a saver about the interest rate preferences, a saver would say we would prefer high interest rate, obviously. And if you ask a borrower about the interest rate preference, then borrower would prefer a lower interest rate. With regard to the exchange rate, if you ask from an exporter, and he would prefer a depreciated exchange rate, because for $1 earned, we'll have more rupee proceeds. But if you ask from an importer, and he would prefer an appreciated exchange rate. So you can see there are a lot of divergences in the preferences among the economic agents. So the issue is that we can't achieve all of the above at the same time, because as we saw, the variables move up and down. And so when when interest rate increases, and the borrowers are worse off, savers are better off. So likewise. So there's some balancing act has to happen. So that's where the central bank comes into the picture. Basically, the central banks attempt to maintain stability in the macroeconomy. I got a quote from the European Central Bank, and what according to its from their website, keeping prices stable is the best contribution central banks can make to improving people's individual welfare. So if you ask from any central banker, the purpose of their existence is to improve social welfare. That's the main vision of central banks. And to achieve that vision, they have monetary policy and other regulatory policies. So, but the overarching thing of these central banks' actions is to maintain stability in the economy without letting these macro variables to move vary with wide fluctuations. So if you take the stable prices as the objective, and that is useful to help to ensure that the economy is growing and our jobs are safe, and we can feel confident that the money that we have in our pocket will be worth roughly the same tomorrow as it is today. So, the basic idea is that central banks are there to maintain stability in the overall economy. And in that context, the price stability has also become so important. And why that is the case, as we can see here, we take inflation, for instance, and we know what is inflation, and that is the increase of the general price level over a period of time. So if there is very high inflation, what happens is our purchasing power gets eroded. So the consumption falls. On the other hand, if you have deflation, which means prices are going down actually, and in some countries like Japan or in the Euro area also had some deflationary episodes where prices are actually falling down. Not that inflation is coming down, but prices are actually falling. It's called deflation, and that would discourage investment, because when producers make their products to sell at a given price, and the price tomorrow is going down, they will have to incur a loss. So that would discourage investment. So output will fall. So for an economy, high inflation and deflation are equally bad. So we need to have some level of inflation which can satisfy this consumption and also incentivizes the investment. So that's the balance the central banks need to strike in general in order to have this desired level of economic growth while achieving or while maintaining inflation at a certain level. So inflation and economic growth are sort of very much correlated in the context. So in general now, modern central banks are basically aimed at achieving these two objectives mainly, that is to maintain price stability and economic stability, by which it means sort of some level of employment in order to maintain this it's called full employment level. That means to maintain unemployment level at a certain level so that generally there are no major stresses in the labor market, and the rate of economic growth is also maintained at a sustainable level over the medium term alongside the price stability objective. And so maintain price stability and maintain economic stability are key objectives of almost all the central banks. Along with that, we have another aspect which is linked to economic and price stability, and that is the stability in the financial system. So that aspect has been more has become more important, particularly in the aftermath of the global financial crisis in 2007-2008 period. And before that, if you remember, if you have read, the world has seen a sort of a depression, economic depression. And because of these factors, the financial system stability has also gained traction in recent years. So if you ask a modern central bank, what are your objectives? And mainly these three aspects are pretty much embedded in their mandate: price stability, economic stability, and financial system stability. So if we come back to the Sri Lankan context, and these three objectives are actually in the law, are written in the Monetary Law Act, following the amendments to the Monetary Law Act introduced in 2001. So I have a sort of a snapshot of this section 5 of the Monetary Law Act, where it specifies the objectives of the central bank. So if I read it with you, Section 5 of the Monetary Law Act, number 58 of 1949, the central bank is an institution which shall be called as the Central Bank of Sri Lanka, is hereby established as the authority responsible for the administration, supervision, and regulation of the monetary, financial, and payment system of Sri Lanka, and without prejudice to the other provisions of this Act, the central bank is hereby charged with the duty of securing, so far as possible by action authorized by this Act, the following objectives, namely economic and price stability. Sort of both aspects are taken into one objective, and financial system stability. So these are called core objectives, or the dual mandate, if you like. And these objectives are there with the view to encouraging and promoting the development of the productive resources of the country. So this is exactly how it is worded in the Monetary Law Act. So what do we mean by economic and price stability? And that is to see a situation where there are no wide fluctuations in the general price level in the economy. And that helps to achieve sustainable economic growth. And when there is price stability, price movements do not have a significant influence on the decision of economic agents. As I mentioned a while ago, when the prices are going up, then the consumption will be discouraged, and the prices are going down, and the investment will be discouraged. So, and those both scenarios make some influence on the decision of economic agents, which is not very conducive, very sort of supportive of achieving the economic desired level of economic growth. So when the price stability is there, where inflation is sort of predictable, low and stable, then economic agents would not make much of an issue out of inflation, and they would continue with their buying decision, purchasing decisions, and also producers will also continue with their investment decisions. So inflation is not a big, is not seen as a big issue that hinders the economic decisions. So that's the idea of maintaining economic and price stability. So if we put in a sort of a graphical setup, the overall objectives of the central bank, we have this on the one hand we have stable inflation, and on the other hand we have stable, we call output gap, which means difference between the expected level of output and the actual level of output. So when we have stable inflation and stable output gap, which means we have price and economic stability. And also we have on the right stability in the financial system. The bottom two boxes show the policy measures or policy tools that are there to achieve these three objectives or core objectives. So for the stable inflation and stable output gap, we have policy rates, the central bank's policy rates with some sort of a rule that they apply. And also for the financial system stability, we have macroprudential measures, which basically impose some regulatory measures on the banks and non-bank financial institutions. And there are interactions between these two cohorts. So this summarizes nicely the overall framework within which a central bank operates. Then I go to the next section. What does monetary policy do in this context? Or how does monetary policy help achieving economic and price stability objectives? What I have in this chart is the economic growth rates of Sri Lanka, GDP growth rate, and inflation rate, the Colombo Consumer Price Inflation Rate, index-based inflation rate, starting from 1960. What we can observe is that there are periods where high inflation, high growth, and starting from the first beginning of the sample, we have low economic growth and low inflation in general. So this blue line is the sort of GDP level, and the orange line is the inflation rate. So when you have low inflation, the GDP tends to be also a bit of low. You take on average is about 2.5 during the sample period. In the second shaded area, we have high economic growth and high inflation. Inflation is actually very high, above 25%, but GDP growth is also bit of on the high side of the above 5%, say above say 6% on average during that second shaded area. If you take the third shaded area, again we see growth is maintained above 5% on average, and inflation remains high, of course, with fluctuations, but still on average it's high. In the fourth shaded area also, we see high inflation and high economic growth. So take on average 6% during the sample period. And the latest period, we have again low economic growth and low inflation. Say the growth is even negative. If you remember during the last year, 3.6% contraction because of the pandemic, and inflation also remains low. So there's a sort of fairly good correlation between economic growth and inflation. When economic growth goes up, inflation tends to go up. When economic growth comes down, inflation tends to come down. And we would definitely like high growth, because high growth means more income for the country in general and more income for the people, individuals and businesses. But the problem is that when you have high growth for quite a period of time, that's followed by high inflation as well. Because when our income level goes up in the country, the aggregate income level, and there will be some more demand for goods and services because of that high income levels. But if our supply side does not respond that fast to the rising demand, and then there will be some inflationary pressures in the economy. And of course, inflation may be also affected by some other factors as well, like say oil price increases or depreciation impact and all. But they are also pretty much related in a way. But in general, what we see is high growth and high inflation are sort of a common occurrence over the history of the Sri Lanka since 1960. But there are periods where there are some divergences as well. Particularly in 2001 period, I hope you can see my cursor. So there are clearly a divergent behavior, because we had a contraction in 2001, but the inflation went up due to some other factors, maybe due to the depreciation pressure. But the bottom line is that, so if high growth is followed by high inflation, to have price stability, we have to bring down inflation. And in that process, we have to bring down our economic growth as well, whether we like it or not. Because high inflation with high economic growth would not make people better off, because your purchasing power of your money goes down. So it doesn't matter whether you have more income if your purchasing power goes down because of high inflation. So that's where the central bank role is important. We would prefer high economic growth and high income, but we would not prefer high inflation, because that is not improving social welfare. So we put that into a sort of a algebraic expression into a central bank's objective function, and you may have learned this from your module. There is a welfare loss function, because we know high inflation is welfare deteriorating, and if there are fluctuations in the economic growth, that is also welfare deteriorating. So the central bank's job is to minimize these losses coming from inflation deviations from a desired level and output deviations from a desired level. That's exactly what you can see here in this expression. This L denotes loss function, and beta is some sort of a parameter or the weight that we attach to inflation stabilization objective. And this pi1 and pi t are the deviation of actual inflation from the targeted level of inflation. And y1 and ye again denotes the deviation of actual output from the targeted or equilibrium or long-term level of output. So economic and price stability means there are only minor deviations between the actual level and the expected level. So that is the job for the central bank to minimize the welfare loss coming from high inflation or low inflation or very high output growth or very low output growth. So bottom line again is that a greater inflation stability comes at the cost of greater output variability. So if you want to stabilize inflation, you got to make an impact on your output variable as well. So that's where monetary policy comes into the picture. And monetary policy is sort of this process by which the central bank influences the cost and availability of money in order to influence the money and credit conditions in the economy to achieve stable level of inflation and stable level of economic activity. So there are two phrases which are important here: cost of money and availability of money. That is the scope of the monetary policy. It affects the cost of money and it affects the availability of money. The cost of money is the interest rate, as we know, and availability of money is the money supply the central bank can do. That's also a measure of liquidity levels in the economy. And central banks in general have a fair amount of control of both these variables, interest rates and money supply. And monetary policy mainly deals with managing the aggregate demand side of the economy, not the aggregate supply side of the economy. So how money supply is related to price stability and economic stability. Or otherwise, how the monetary policy is related to price stability and economic stability. There are theories, different theories for that. So if I take a sort of very basic theory, which is called quantity theory of money, or QTM, and this is a monetarist sort of explanation popularized by the great monetarist Milton Friedman. And according to that theory, there's some resemblance between the growth of money supply and growth of nominal GDP. So the growth rate of money supply is sort of equal to the growth of nominal GDP. And that nominal GDP comes from the that is on the right hand side. On the left hand side, we have money and velocity. Velocity is how many times the rupee gets changed from hand to hand. So we can see, according to this theory, there's a quite direct relationship between money supply and output. So if you increase money supply, that is, you increase the left-hand side of the equation, and then the right-hand side of the equation has to increase or go up as well. And whether it is an increase in output, whether it is increase price level, or whether it is an increase of both, will be dependent on the economic circumstances. So of course, we would prefer a high money growth leading to high economic growth or high output. But if prices also go up, then there's a problem there. So then you have to control the money supply at some point so that there's a balance between output increase versus price increase. But this theory is sort of a basic theory, and some economists do not sort of accept the basic tenets of this QTM. Mainly the Keynesian economists would prefer more a role for the fiscal policy than money does in the economy. So let's see the relation between the money and inflation. So as we know now, more money will lead to either output increase or price level increase. If it is price level increase, then it will lead to inflation. So this is again taking Sri Lankan data set from 1960 up until now. I have plotted M2 because M2B is the broadest definition of money supply, which is not available from 1960. We have taken the M2 and then the CCPI inflation. So what we can see is that in general, there's a good correlation between the two. High money growth is followed by high inflation, and low money growth is followed by low inflation. So there is some empirical evidence to support the QTM claim. So let's look at another chart which shows the relation between money growth and GDP growth. Again, same data sample, real GDP growth rate and M2 growth rate. Again, the relation is not quite clear because of the differences in the level of the data series. But again, in general, we cannot rule out some positive correlation between the two in major part of the sample that we have selected here. We have some money growth, high money growth is leading to some sort of high economic growth as well. But in this period, we can see very high money growth, and in GDP also increases. Here also high money growth, high GDP. Here also high money growth, high GDP, and low money growth will result in. So there is a positive correlation to a large extent, but these are not causality effects. I just want to highlight that point as well. I'm just showing some correlations only, but not any causation. Because in theory, what we believe is money is neutral in the long run, because more money would not support economic growth. Otherwise, everybody will print more money to achieve high economic growth, and that wouldn't happen because inflation comes into the picture, so that we have to lower or decelerate the money growth so that inflation is maintained at the desired level. And one channel I want to basically stress here is that how money growth supports the economy, by which I mean the economic growth and the inflation, and that is through a credit channel. Because we know money and credit are very much correlated, because if banks have more money and they would lend, so that would increase the credit to the private sector. So that is what we can see here in this data set. These are quarterly data starting from 1997, and there is a very good positive correlation between money growth and growth of credit to the private sector. So if we want to control sort of money, so we can control the credit growth as well, because the credit usually goes for investment by producers and also for some consumption by consumers. So, and that would have some aggregate demand uh, in the economy. So if we want to decelerate the economic growth, we can decelerate the credit growth. And because we have some control over money growth, because central bank is supplying money, and we can reduce the growth of money so that the growth of credit is also maintained at a desired level. And this chart shows the relation between credit growth and inflation. Again, we see some sort of a positive correlation between the two. When you have high credit growth, and that was also will lead to high inflation, and that is because of some aggregate demand that is built up in the economy. So you can allow the credit to grow up to a certain level or at a certain percentage, and beyond that, if credit grows sort of beyond that desired level, and the inflation will start uh, increasing. So we have to control the credit through money so that inflation is maintained at the level that we want. And how do we sort of manage credit or control credit? And that is through some sort of an interest rate adjustment. And because if you have very high interest rates in the economy, and the borrowing cost becomes so high, so that borrowers are discouraged. And so if you want to discourage credit after a certain level, then you can start raising interest rates so that making borrowing more expensive. So again, the central bank has the tool to do that through the policy interest rate adjustments, and also through the conduct of open market operations to maintain uh, adequate level of liquidity in the interbank money market. So that's kind of a bit of a background to the topic so far. Um, I assume that it's clear. So if there are sort of any clarifications to be sought, we can have those. If not, we can move on to the uh, main theme. Right. The silence implies I think, no sort of issues so far. So let's take the monetary policy making aspect at the central bank and how it is implemented here in Sri Lanka. So in the practical sense, the monetary policy rate or monetary policy decisions rather are taken by the monetary board. Monetary board comprises 5 members: governor, secretary to the treasury, and there are 3 appointed members from outside. So there's a 5-member committee, and that monetary board takes all monetary policy decisions. And monetary policy decisions are mainly involved some policy rates adjustments from time to time, as well as some other tools like the statutory reserve ratio on deposit liabilities of banks, and also some ceilings in some credit growth to some certain sectors of the economy, and also some sort of margin requirements on imports, because all these are connected. So if you have, say, high credit growth, then you go to tighten these measures. You go to increase policy interest rates, and you can increase the SRR, or the statutory reserve ratio, or you can impose some ceilings, the maximum credit growth allowed in certain sectors, or you can impose some margin requirements. That means when you import, you got to deposit certain percentage of your LC amount with the bank, non-interest bearing sort of form for that period. So these are the basic sort of aspects that the monetary board takes into account. So I'll sort of describe in detail in the forthcoming slides. And then the Monetary Policy Committee. So for the monetary board to decide on the appropriate monetary policy, there should be a comprehensive analysis that should go to the monetary board from the Monetary Policy Committee. Now, Monetary Policy Committee is also chaired by governor and also attended by some key departments of the central bank. Economic Research Department is one of them, and there are other few departments that are members of the Monetary Policy Committee, like the International Operations Department, which deals with the exchange rate, reserves, kind of matters, and Domestic Operations Department, which is responsible for conducting open market operations and liquidity levels in the economy, and the Statistics Department, which basically compiles, sort of collects inputs from the DCS, so Department of Census and Statistics, with regard to GDP and inflation developments. So the Monetary Policy Committee basically analyzes all the developments taking place in the economy, covering all sectors of the economy, including real sector, monetary sector, fiscal sector, and external sector, and the financial sector as well. So these inputs go to the monetary board so that they assess the current macro developments, and also they evaluate the emerging trends in the economy, because the MPC provides forecasts as well with regard to key macro variables for consideration of the monetary board. And also MPC gives some recommendations to the monetary board with regard to the appropriate direction of the monetary policy. So this is a sort of a graphical way summarizing the monetary policy decision making and implementation process. So at the beginning, we have the Economic Research Department doing the analysis on the real sector, external sector, fiscal sector, monetary sector, plus the global macro developments, like what happens to the global price levels, like commodity prices, oil prices, and other food prices and all. And these inputs go to the Monetary Policy Committee, MPC, with some projections on economic growth, on inflation, on interest rates, and on exchange rates, along with the inputs from other departments I mentioned, Statistics Department, Domestic Operations Department, and International Operations Department. And then after deliberation at the Monetary Policy Committee, which is chaired by Governor, and that recommendation goes to the Monetary Board to make a decision on the appropriate monetary policy stance, whether to increase interest rates, whether to reduce interest rates, whether to maintain interest rates at the same level, or whether to change the SRR, or whether to impose some credit ceilings or margin requirements, and the rest. And the monetary board takes that decision. And if you have been following the central bank websites and all, on the following day, we publish early in the morning the decision taken by the monetary board. So we prepare the press release based on the monetary board decision, and after with the approval of the governor and deputy governor, we send the press release to the communications department to publish in the morning. And on the same day, we have a press conference with journalists coming to the central bank before the pandemic. Now, of course, we have these online press conferences. And the operational departments, which are the DOD and IOD, the domestic operations and international operations, they implement the monetary board decision. So if I go back to another step, another level, how the monetary policy sort of a formation happens at the staff level before inputs go to the monetary policy committee, and there are different meetings that take place in that process. We call monetary policy cycles, and per year we have 8 monetary policy cycles based on the availability of data, mainly the GDP data. Of course, inflation data are available on monthly basis, but GDP data are available only on quarterly basis, and they also come with a lag. We have 2.5 months of a lag before they release the previous quarter's GDP numbers. So in the say first quarter, GDP figure usually comes in mid-June. But this time around it was a bit delayed because of the pandemic. But usually first quarter numbers come in mid-June likewise. So the first meeting that we have is the first staff level meeting, and that is to take a stock of developments of the economy, covering all the sectors of the economy. With regard to inflation, with regard to GDP developments, and with regard to fiscal sector like budget deficit, revenue expenditure, debt levels, debt servicing, debt financing, and the external sector, covering basically the balance of payments, exports, imports, and the remittances, and the income account related foreign direct investment related transactions, and debt related transactions, and the commodity prices, like all the in the consumer price basket, we have different items, the food inflation and non-food inflation, and there are analysis on all these aspects. Plus the monetary sector, about the liquidity levels, the interest rates, the growth of credit to the government, growth of credit to the private sector, growth of credit to the other corporate sector and the state-owned enterprises, and all these aspects. And also we discussed the sort of a near-term forecast of GDP and inflation, like for the next 2 quarters, what are our forecasts on GDP and inflation? That's the first staff level meeting. And in the second staff level meeting, after collecting this information from the first staff level, we have a modeling team in the department which can take all these inputs into the model and do some basic forecast, projection on the medium term path of GDP, inflation, interest rates, and exchange rates. And also we assess the main assumptions that we are making and the sort of global developments as well. And also we take the risks to possible risks to those forecasts. And what happens if one of our assumptions is violated, how that would affect the GDP growth path, or inflation path, or interest rate path, or exchange rate path. Likewise, yeah, within our departments, we are discussing this. And then these inputs go to the pre-MPC meeting, that is pre-monetary policy meeting. Now that is also chaired by a governor. Before it was chaired by the deputy governor. And at that meeting also we discussed these macro developments plus medium-term projections and possible monetary policy actions with regard to maintaining inflation, maintaining price and economic stability. So within that mandate, we do all these things. And there's another meeting which happens in parallel is the Monetary Policy Consultative Committee meeting, MPCC. And that includes all the outside members chaired by an outside member as well. So we as internal staff participate at the meeting, but we basically hear the views of the private sector. And those views are also important for monetary policy formulation. And then these pre-MPC meeting inputs and MPCC meeting inputs go to the Monetary Policy Committee meeting. And there we discuss the possible recommendations to be submitted to the Monetary Board with all the developments and the projections, model-based projections. Then Monetary Board, taken into account all these developments and the recommendations by the Monetary Policy Committee, decides on the appropriate monetary policy stance, which will be published and which will be operationalized by the operational departments. And then after the Monetary Board meeting, we have another post-mortem staff level meeting to discuss and summarize the main takeaways of the monetary policy round. So this is, in a nutshell, the process of monetary policy making at the central bank. So with regard to, so before I come to the sort of decisions that we have taken during the pandemic, so there are some rules of thumb for monetary policy decisions. So if we take, say, mainly three aspects here: economic growth, inflation, and exchange rate. With regard to economic growth, if the economic growth is too high, because for an economy there's a sustainable level of economic growth given the resource availability, given the factors of production. But if you employ these factors of production or exploit those by deploying more than what you can maintain over the long run, of course we can achieve some higher economic growth in the short term, but which is not sustainable in the medium to long term. That's where we call the economy is overheating, because the level of production in the economy cannot be sustainable without further expansion of factors of production or resource availability. So if such thing happens, we will see demand pressures building up in the period ahead. So when the economy is overheating, the rule of thumb is that we need to cool it down. How we cool it down? By raising interest rates. So by raising interest rates, you discourage the borrowers, the credit growth, and the investment and consumption. So then you can basically pull it down, this high level of economic growth. So why we do that? Not that we don't like more income, just because we don't like more inflation in the ensuing period. So when the economy is overheating, we raise interest rates as a rule of thumb. On the contrary, if the economy is growing at a very slow rate, below the potential level of the economy, then what do? We lower interest rates so that you make more money available in the economy. Corporates can borrow and invest at a low interest rate. Consumers can borrow and consume at a low interest rates. So, rule of thumb, when the economy is operating below its potential, we lower the interest rates. That's on the economic growth aspect. On the inflation aspect, which is of course related to growth aspect, is that when you see inflation rising, or medium-term projections are suggesting some uptick in inflation, then again we increase interest rates. Because when you again, same outcome that you expect, you make borrowing costly, so that credit growth is slowed down, and sort of aggregate demand is slowed down. On the contrary, if you have very low inflation, or inflation is going sort of below the level, desired level, then you lower the interest rate again, so that again consumers can borrow more and consume, producers can borrow more and produce. So these are the rules of thumb that we use in the monetary policy making decision. With regard to exchange rate, so if you see a depreciation pressure in the exchange rate, depreciation can happen due to various reasons. One reason is import demand. So when you have very high growth of imports, because Sri Lanka is a country which has a trade deficit. Our export income is half of the import expenditure. We have say 10 billion, 10, 11, 12 billion of export income, USD terms, and we have 19, 20, 21 level billion dollars of imports. So always there's a trade gap. And when you have very high import growth, there would demand a lot of dollars, so the rupee will come under pressure. So by raising interest rates, you would decelerate the demand for imports, because a lot of importers borrow in domestic currency and then use those proceeds to borrow dollars from the bank system to pay for imports. So if you increase interest rates, the borrowing capacity is affected, so that you can sort of reduce or lessen the depreciation pressure on the currency. And the contrary, if you have an appreciation pressure, which is not very common in Sri Lanka though, because of our structured economy, then you have to lower interest rates, so that you can promote imports and sort of get this exchange rate at the desired level. But I have this yellow box to say that these choices are often not straightforward, because they interact with various other macro variables and involves processes with some trade-offs in varying time frames, because there's a transmission mechanism in monetary policy making that today's actions will have an impact later in the period ahead, maybe next quarter, maybe 2 quarters later, even 3-4 quarters later. And in some advanced economies, that so-called transmission lag is 2 years long. So if you want to reduce inflation now, 2 years ahead, we have to act now. So that long is the transmission mechanism in certain countries. So with sort of those rules of thumb, and we have different stances of monetary policy. And there are mainly of 4 types. We call hawkish monetary policy stance. We have dovish monetary policy stance. We have accommodative monetary policy stance, and we have neutral monetary policy stance. The hawkish approach to monetary policy is that maintain high interest rate so that inflation is in check. So inflation is maintained at the desired level at the cost of economic growth, at the cost of economic activity. You maintain inflation at the desired level pretty much on average all the time. That's the hawkish monetary policy stance, rising interest rates sort of a period, or raising interest rates to maintain inflation. The dovish monetary policy stance is the opposite. You lower the interest rates so that you would entice consumers to take credits and to borrow and consume. Producers can borrow and invest. So that's the dovish monetary policy stance. The tendency of low interest rates. The policy rates are going down. And the accommodative monetary policy stance is that you expand the money supply, the overall money supply in the economy to boost the economy when the economic growth is slowing down. Again, by promoting spending through borrowing. So you keep expanding the money supply so that more money is available in the market, liquidity is high, credit can grow. So you spend and make aggregate demand, and then through that you support the economy. Neutral monetary policy stance is that the policy rates neither stimulates nor restrains or constrains the economic growth. So the policy rates are maintained at a certain level without change, without increasing or decreasing. So these are the four stances of monetary policy, and we will see what is the current monetary policy stance of the Central Bank of Sri Lanka. We operate our monetary policy within a framework and with a certain set of instruments or tools. So our current monetary policy framework is inflation targeting framework. We call a flexible inflation targeting framework. But there are different frameworks adopted by central banks globally. So inflation targeting is more popular or more widely adopted at present, which basically involves an inflation rate or a target range being published by the central bank, and then we do forecast of inflation. Then we adjust our policy interest rates to achieve the target inflation rate or the range of the inflation. That is through the inflation targeting framework. And some central banks do price level targeting. Your consumer price level index is maintained at a desired level. So any deviation of the price level is basically offset by subsequent changes in the price level through monetary policy measures in the following years. And some small open economies like Singapore, Hong Kong, they do exchange rate targeting. So they basically, because they are very much open to the world economy, so exchange rate is very sensitive in their structure of the economy, which affects the price stability through imported inflation. So they target exchange rate directly. But for that, you need to have a lot of foreign reserves, because when you have pressure in the market, you have to pump in dollars, and when you have a lot of dollars in the market, you can absorb dollars. So not all countries are able to do that exchange rate targeting if you have limited stock of reserves. And some central banks do multiple indicator targeting, where you have targets for monetary aggregates, you have targets for interest rates, you have targets for certain level of exchange rate, and achieve price stability by controlling all these variables. Some central banks have nominal income level targeting, where you basically target a certain level of GDP in nominal terms, so that your price pressures are managed through that. And the old-fashioned monetary policy framework is the monetary targeting, where you try and control the money supply to achieve price stability objective. But with the developments in the technology and all, the control on the money supply by the central bank has sort of diminished to some extent. So, as I mentioned, the Central Bank of Sri Lanka has been following the monetary targeting approach historically, but recently we have moved to inflation targeting framework because of the divergence between the nominal GDP and the money growth. To highlight that point, I have this chart. These two lines show the nominal GDP growth, the orange line, and the broad money growth in the blue line. And these dotted lines and the broken lines are the average money growth and average GDP growth. So see in the first half of the sample, these average growth rates are pretty much overlapping. So there's a very close correlation between the two. They are growing at the same level. So by controlling money supply, you can easily control the GDP. But in the second half of the sample, they deviate. The average nominal GDP growth remains low than the average money growth. So this divergence basically wanted a shift in the monetary policy framework where the central bank moved away from monetary targeting to inflation targeting. Inflation targeting refers to some sort of a hard sort of stance on inflation, achieving the inflation objective at the cost of output. But the flexible inflation targeting, for development introduced later on, is that the monetary policy aims at stabilizing both inflation around the target and the real economy, the growth of economy as well. So there is some consideration not only on inflation, but the economic growth aspect as well. There is some flexibility in terms of achieving the price stability objective. And also there's some flexibility in terms of achieving the target level of inflation within a target horizon. So we can't achieve inflation even if you have a target every month, every quarter. Is on average, you try and achieve the desired level of inflation. So if you take the inflation quarterly numbers, these are monthly numbers, the Sri Lankan inflation series from 1979 January. You see the last 12 years, inflation remains sort of well behaved, which is less than 10%, and on average, it's about 5% the last 12 years. But if you take the other set of the sample, inflation is very volatile. In that situation, you can't really target an inflation rate. Your projections can be wrong most of the time, but in the last decade or so, you can, with some good degree of confidence, you can forecast inflation. So if you can forecast inflation correctly, you can target such variable and adopt monetary policy or adjust monetary policy to achieve that target. What are the instruments that are available in the monetary policy framework, the flexible inflation targeting framework? Now, if you wonder what is our inflation target, and that is a range 4 to 6%. That's our target inflation range in the monetary policy framework. And that depends from country to country. And most advanced economies have a 2% inflation target. But in our case, and those countries have the real GDP growth rate also not that high, on average in the 1 to 3% range. But when we have growth rates, so we used to have growth rates around 7%, 8% certain periods. So money growth also high, and inflation also has to be adjusted or kept in line with the growth rate of the economy. So that's why we have a pretty much a high range of inflation, 4 to 6%. So on average, we would prefer to maintain inflation at 5% level, the midpoint of the range. To do that, we have tools. What are the tools? The main set of tools are the policy interest rates, which are the standing deposit facility rate and standing lending facility rate. So standing deposit facility rate is the rate at which the commercial banks deposit their excess funds at the central bank on an overnight basis. Standing lending facility rate is the rate at which the commercial banks can borrow money from the central bank on an overnight basis to fulfill their liquidity requirements. So this is the main two policy interest rates that we use. There's a corridor. There's a policy interest rate corridor. The deposit rate is the lower bound of the corridor, and the lending facility rate is the upper bound of the corridor. These are the rates available for the banks to transact with the central bank, not for customers, not for depositors. And so by adjusting the policy interest rate corridor, we can make the borrowing cost high or low for the commercial banks. And the other main policy tool is the open market operations, OMOs. That is to basically support the liquidity levels in the interbank market. So if there is a liquidity shortage in the interbank market, the central bank can pump in liquidity through conducting auctions, treasury bill auctions. So we announce we are sort of, so if there's a shortage in the market, we are buying treasury bills from the banking system so that in return we give rupees so that money market becomes more liquid. So that is when there's a shortage. And if there's a surplus liquidity in the market, then we say we are absorbing the surplus liquidity from the market by auctioning treasury bills. So the central commercial banks can get treasury bills in exchange of rupee proceeds. So through that, we maintain a desired level of liquidity in the money market. So these are two key sets of tools that we have been using in implementing monetary policy. And the other main tool is the reserve requirement, and that is the percentage of the deposits, rupee deposits, that the commercial banks are supposed to maintain at the central bank in the reserve maintenance period. There's a 1 month cycle, 2 weeks maintenance period, and 2 weeks sort of observance period. And in the 1 month period, you got to maintain the reserve requirement, the level at the given or at the specified level. Now we've been used to have very high reserve ratios in the past, but now we have cut it down to 2% level at the moment, because of the pandemic. So we will see the details in a bit. And other instruments are the bank rate and the quantitative restrictions on credit and ceilings on interest rates and some refinance facilities. The bank rate is the rate at which, as the lender of last resort, the central bank charges on a financial institution. If they have a very dire need of liquidity, they can come to the central bank as the last option. So which is very rare, these kind of bank rate being used at the moment, and we will give funds to that institutions at that rate. The quantitative restrictions on credit is that when you have very high credit growth in the economy, we can impose maximum growth of credit across the bank or some specific sectors. Say we can say the SME sector. So if you need to support SME sector, for instance, so we can say the bank should have at least this much of credit going to the SME sector. So if you want to limit, say, credit to the import sector, we can say the maximum level of credit that should go to the imports is this much. So likewise, you can impose some quantitative restrictions. And also you can impose some ceilings on certain interest rates in the market. So we have used some ceilings already. I have slide on that. And so that we cap the maximum rate the banks can charge from the customers. And also we have refinance facilities where we give funds to banks, and these funds are lent to borrowers in identified sectors at very concessionary interest rates. That's also operational at the moment with the pandemic. And then the other set of tools are the moral suasion and forward guidance. The moral suasion is something that we do on regular basis with the commercial banks through meetings with the bank CEOs and bank chairpersons about our expectations of the economy in the period date and what we expect from the banking community in achieving or in realizing those expectations in terms of interest rate adjustments, in terms of credit movements, in terms of support for exports and imports, likewise. And forward guidance is something that we use to highlight or sort of indicate what are our directions about the monetary policy in the period ahead. That is basically done at the beginning of the year through the announcement called roadmap. If you have, again, if you visit the Central Bank website, you can see the previous presentations of the documents on the roadmap, where we basically highlight our expectations of the monetary policy movements or stance given the inflation and the economic growth outlook. That's also very useful for the industry and for everybody to make their expectations, to make their plans accordingly, because that will basically give some certainty about the monetary policy actions in the ensuing period. So with that, before I move on to this current measures that we have been sort of taking, as I mentioned before, there's a monetary policy transmission from the policy instruments that I mentioned a while ago to the goals, economic and price stability. There are a lot of things that can happen in the transition, and there are different factors at play, because the economy is something which is very interconnected, the sectoral linkages, and if you do one thing in this sector, will achieve the other sector, and then through that the other sector. So there are a lot of connectedness in the economy. So that's why it's called a black box. And that black box is explained to some extent by this chart. Today's policy actions will affect sectors, economic sectors in different ways, through market interest rates, through the volume of credit, through asset prices, through expectations, the inflation expectations, through exchange rate, and everything is combined will affect the domestic demand and the external demand. External demand is basically imports and exports, and we have domestic demand, the consumption, investment, and government expenditure and all. And that would basically formulate the total aggregate demand in the economy. And when the total aggregate demand in the economy will affect the inflationary conditions of the economy. If the total demand, aggregate demand is going up by more than what we expect, that would basically put pressures on the price level, and that would lead to inflation. So if you tighten monetary policy, if you increase interest rates, and through these channels, either by reducing the credit or other expectation channels, you can make an impact on the aggregate demand. Through that, make an impact on the price level or the pressures on the price level, and through that, you make an impact on the ultimate goal of inflation. So, as I said, there are various sectors that are in operation at a given point in time, and today's actions will go through all these channels. And the important thing is that there are time lags. So if you want to bring down inflation next month, by increasing interest rates today will not happen, will not help. So that's why we are doing some projections on the economy. What will be the inflation level next year, or 2 years later, or 3 years later, over the medium term, like say 5-year horizon. Likewise, what is our projection on the economic growth path? It will be the economic growth path next year and next 2 years. So if economic growth is projected to be very high, above the long-term level of the economic growth, and that would increase inflation for sure. And then you go to tighten monetary policy today so that inflation is maintained at the desired 4 to 6% range. That's why, this is not an easy task. There are rules of thumb, but there are very complex developments that can sort of operate in the economy, so that your policy instruments and the adjustments need to be always made in line with the developments taking place at present. Say if you have a global oil price shock, and then your policy plans would need to be adjusted in line with the effects that can come from the global developments as well. So you got to be fine-tuning your monetary policy, sort of making so that changing the instruments in a suitable way to hit your ultimate goal of maintaining economic and price stability. So with that, let me come back to the sort of final phase of the presentation, the recent monetary policy measures. So before that, let me show you this chart, which basically summarizes the economy by the end of 2019. So let's have a closer look. We have 5 variables: GDP growth, inflation. This AWLR is the average weighted lending rate. It's kind of a cost of borrowing, if you like, and overnight liquidity, the liquidity levels in the interbank money market, and the yellow line, the private sector credit growth. So if you take the 2019, what we have here is that our AWLR or lending rate remained high, above 10% level. And our credit growth remained very low, below 5% level. So that's something that would have been expected because high interest rates would discourage credit growth. So that's there. And our inflation, which is given by the dark blue line, is also bit of on the low side, modest level, because low credit, low level of inflation, around 5% level, right at the midpoint of the target inflation range. And also, I have this extra arrow looking for that. It's a liquidity levels. Liquidity level, which is the blue bars, you see there's a sort of a modest level or low level of liquidity in the market. That's why we have low credit growth. That's why we have very high interest, sort of not very high, relatively high interest rate. So we have high interest rate, low credit, low liquidity, and modest level of inflation. And if you take GDP growth is also low, the red bars. So it has been coming down since 2012 with the, of course, the rebasing of the GDP series by the DCS also had an impact. But 2019 anyway, the Easter Sunday attacks and all, there were some negative developments taking place in the economy as well. So that's where by 2019 positioned, and then we are again going to witness another shock from the pandemic. So economy was not doing well, growth was low, inflation is modest, credit is low, liquidity is low, interest rate is high. So as now you have learned what you do in the central bank. So what you would do in such a situation? Because you are facing a serious economic shock as well with the pandemic. So you want to, again, go back to the previous slide. So now you want to support economic growth because economy is growing below the capacity, below the potential level. So you need to support the economy because your inflation is not high. So you can basically relax the monetary policy by lowering interest rates. So by bringing down the purple line, the interest rate, AWLR, so you can increase the yellow line, the credit growth, and you can increase the red bar, the economic growth. And if you lower interest rates, you can provide more liquidity in the money market, those blue bars as well. So that's what you'd have done given the shock. So this is the outcome of the central bank policy actions since January 2019 I have shown, but the action now 2019 end is somewhere here. Right? This is December 2019 that we saw. So even before that, you see we have been doing some, I forgot to mention these two lines. These are the policy rates, the standing deposit facility rate the green line, and the standing lending rate, right? This red line. So this is the policy rate corridor. So this is the main monetary policy decision, whether to increase policy interest rates or whether to reduce policy interest rates, done through these two lines. And you see, let's read these lines again. This blue line is the interbank call money market rate, average weighted call money rate. This is the bank interest rate through which the money market operates. So from their peer banks, they borrow and lend at that rate. So usually that interbank money market rate is hovering within the policy interest rate corridor. So if you reduce the policy interest rate corridor, you see the interbank money market interest rates also comes down. And that interbank money market interest rate is linked to the market deposit rates and market lending rates. So if you want to reduce the lending rates or cost of borrowing, what central bank does is we reduce the policy interest rates, and that triggers a reduction in the AWCMR, and that affects the lending rates in the money market. So that's exactly what we have done in 2020. So this is the period 2020. So in January, did I, something went wrong, right?
Yes, now could you please share the screen back, sir? We cannot see the screen.
Yeah, okay. Can you see now?
Yes, sir, we can see.
Can you see now?
Of course, sir, we can.
Okay, right.
Thank you, sir. Thank you.
Okay. So what I was saying is that we've been sort of relaxing the monetary policy stance. So-called, we'll be adopting a dovish monetary policy stance, if you like, by the jargon that we have used, because of low economic growth, because of, so this blue area is the liquidity levels. These pink bars are the credit growth. See, monthly change in private sector credit. This is the volume of credit. And this is over. We have negative liquidity and very low credit growth and high interest rates. So because of that, GDP growth was low. And so we've been reducing the interest rates, so that money market interest rates also came down, and liquidity levels was sort of became positive, and the credit was also picking up. That is by December 2019. But we got to know there was a huge demand for money in the market, because sometimes people were also panicking and they want to withdraw a lot of money, and the banks were also seeing a lot of liquidity need. So we've been supplying liquidity in the market by reducing the SRR, the statutory reserve ratio, as I mentioned. So the liquid levels you see is increasing at a very high level. See, the liquidity has increased to unprecedented levels, right? And also we've been cutting the policy interest rates in successive months to a very low level. Right? Now this is 2% at the moment, 4% at the moment, 4.5, sorry, 4.5. And the lending rate is 5.5. So there's a 1 percentage point gap in the policy rate corridor. And the SRR is at 2% level. I think I have that in the next slide. So 2% level SRR, and the standing deposit facility rate is 4.5. And the lending facility rate is 5 interest rates. And the AWCMR also came down quite sharply at the 4.5% level. And you see if you go to bank to open a savings account or a fixed deposit account, you get a very low rate because we had to support the economy, and savers again are sort of worse off, but borrowers are better off because we need more borrowing, we need more investment to support the economy, and through that process we can see some build-up of credit in the economy. So credit is picking up bit by bit, and at the moment what we see is the level of AWCMR. This is mainly because the government, because of the pandemic, government revenue also got affected. So government wanted to borrow funds from the market at very high levels, so that there's a pressure in the money market, because on one hand the private sector also using liquidity, and on the other hand the government is also using liquidity, so that there's some pressure building up in recent months in the money market. So we see the interbank money market rate is inching up, but still within the policy rate corridor. So I think there's a problem again. Let me share again.
Yes, sir, there is a connection drop, I think.
I think I move my cursor here and there. That's me. How about now?
Yes, sir, it is visible now.
Okay, there's a problem with the network, I think. Did you miss anything that I mentioned?
I think few 1 or 2 minutes. Now we are here, sir. So we were talking about
Okay, right.
the slight increase in the money market.
Right. Yeah. No. Yeah. Thank you. I was explaining why the sort of recently the interbank money market rate is inching up, because of the increased government funding requirement very badly. So that while the private sector also needs cash, government also needs cash. So there's some demand for liquidity from the government as well as from the private sector. So therefore, some pressure in the interbank money market happening at the moment. But we still maintain the accommodative monetary policy stance by allowing more liquidity in the money market. Of course, the liquidity level is coming down gradually. because now we have been maintaining this accommodative monetary policy stance since July last year. After this dovish monetary policy stance of cutting interest rates down pretty much in multiple locations, and then we have come to sort of a level where interest rates reached historic low levels, and so cutting further down would really sort of worse off the savers. So we need to at least strike some balance between savers and depositors. But these historic low interest rates have helped us to increase credit to the private sector and maintain the economic momentum to a large extent. So this slide summarizes the actions that we took since January last year through July this year. So as I mentioned a while ago, in January we cut the policy interest rates, the SDFR and SLFR, or the standing deposit facility rate and the standing lending facility rate, by 50 basis points or 0.5%. And then in March, we have reduced the policy rates again by 25 basis points. And also we have reduced the SRR by 100 basis points, that means 1%. The statutory reserve ratio, through that, we have provided a lot of liquidity in the money market. So these are the lines that you see, the policy rate adjustments that we did. This is the January cut, and then you have March 25 basis point, and you have in April another 25 basis point reduction, and in May another 50 basis point reduction, right? And in June we have cut the SRR, this blue line. You see the 200 basis point reduction in the statutory reserve ratio to 2% level. So this is the maximum. We've been reducing the SRR since January, and in June we have cut it by another 2% to reach historic lows of 2% level, while maintaining since then. And in July we have cut again 100 basis points, by 100 basis points, the policy interest rates, both deposit rate and the lending rate. And since then we've been maintaining that accommodative monetary policy stance, so that more money is available in the market at low interest rate, so that people can borrow and do their businesses. And while maintaining that accommodative monetary policy stance, we have taken some other measures in our tool that I was explaining, some targeted measures to reduce some specific excessive interest rates, like credit card related interest rates, or some gold pawning interest rates. So likewise, in November, if you remember, we introduced ceiling on the housing loans, 7% maximum for the salaried employees for the first 5 years, and then flexible interest rates after this. So that's another tool that we have used, imposing maximum interest rates. And in January this year, we used some sort of SME sector lending targets for the banking sector, because we needed to give more support for SMEs in the pandemic, during the pandemic, because they were the sort of first hit by the pandemic. So we wanted to give more money for them to meet their working capital requirements and sort of continue their business operations. So we imposed some lending targets on SME sector lending. And then since March through July, in the monetary policy sort of press releases, we have reaffirmed our commitment to continue in the current accommodative monetary policy stance. So that's basically the summary of all the monetary policy operations that we've been doing. And And this slide gives the numbers in terms of our maximum interest rates that we have imposed on credit cards, 18%. That was as high as 24% at some point. And also the pre-arranged OD rate, 16%, and gold pawning facilities, 10%, and the penal interest rate over regular interest rate was capped at 2%, and the housing loans, mortgage-backed housing loans for salaried workers, 7%. So likewise, during that period. And also the other tools that we have used include these concessional loan schemes. If you remember, 4% interest was charged at this Saubhagya COVID-19 Renaissance facility, and there were total borrowings amounting to 180 billion in total. And in addition to that, we have provided some debt moratoria for various individuals and businesses, particularly the tourism sector, which was severely affected due to the pandemic, and also some interest rate waivers in respect to leasing facilities and the lending targets for MSME sector. Also some forward guidance and some moral suasion with regular meetings. Even today also we have at 2:30 the bank's chairperson's meeting, online meeting. So we are meeting them regularly to sort of share our expectations with the banking community so that we all are working towards achieving a common goal. And I have only a couple of more slides because I know we have now almost come to the end of the session. So this chart, slides rather, shows the impact of the policy rates or monetary policy measures so far on the money market interest rates. So we know the deposit rates have come down to very low levels. So starting from say 2019, right, this level, and to very low level by now, almost half. So 10% level came to 5%, right? Almost by half. The rates have reduced by half. And the lending rates also, actually by December 2019, 13.5%. This AWLR, the average weighted lending rate, which came down to 9.64, and 12.8% level has now come down to 7.7. Likewise, there's a notable reduction in the deposit rates as well as lending rates. Of course, we would have preferred to maintain deposit rates at high level, but you can't do that when the impulse interest rates are reduced. Both rates come down, and the banks would first reduce the deposit rates and then the lending rates. And with regard to liquidity, so we have managed to bring up the liquidity levels to very high levels in 2020, from negative levels in 19 January, and then to low positive levels to very high positive levels in 2020 by the SRR reductions, 100 basis point cut and 200 basis point cut. So this is historic high levels of liquidity in the money market, and therefore the currency in circulation has also remained very high. So these are the levels of 2018, 19 and 20, and 21 people preferred to hold cash because of the pandemic, and for that to accommodate, you got to provide a lot of liquidity in the market. So if you have no liquidity in the market, that would basically that would put upward pressure on the interest rates, so that we can't achieve our objectives. And as I mentioned already, the credit is picking up now. And that is something that we wanted to happen by lowering the interest rates. So we see momentum in the credit to the private sector is gathering pace. So we will expect that trend to continue, so that will support the economic growth in the period ahead. And we saw the GDP numbers came. The first quarter GDP was better than expected, feared. So it's got 4.3% first quarter GDP this year, compared to the contraction in the last year. And we expect the in the coming period, we'll have some positive GDP numbers this year and over the medium term. I think my final chart slide is on the inflation. Inflation in general is within the desired range. So that's why we've been able to maintain this accommodative monetary policy stance for this long. Because if there are inflationary pressures, and that is our main mandate, so we need to sort of do something to get the inflation back into the range. But so far, we have been able to maintain inflation rates within that band of 4 to 6%. But due to the food inflation pressures due to the mobility restrictions and supply side factors, the weather and all, there are some sporadic increases in the price level. But on average, we've been able to manage inflation within the desired range. And if there are pressures building up in the period ahead, we may need to take some corrective actions. But the issue is, with the very low economic growth, you need to have some sort of accommodation to get the economy up and running post-pandemic period, while maintaining inflation at the desired level. I think, Dr. Amartunga, that summarizes my sort of a message or presentation for today. Thank you, and I hope it is sort of it satisfied your expectations, or it met your expectations. Thank you. You're on mute.
Yes, you are muted.
Thank you very much, Dr. Harischandra. It was a wonderful presentation, and you gave all the insights of the session, because always we teach the students the theoretical background, and you gave a very good practical experience. And also, I think according to what I learned from you, is actually you all are going to do you all are going to take every step to increase the aggregate demand of the country to achieve economic growth target. So
that's
aggregate demand increase,
and while maintaining inflation,
and it was very good to discuss about the objectives of the central bank, because those things are new to the students. So I think we also learned a very good stuff from you. So thank you so much, and with
my pleasure.
All your work, I know that you're supposed to sit on another meeting at 2:30, and I don't know whether you have taken your lunch even.
I will have lunch, 10 minutes.
So thank you so much, and
thank you, my pleasure.
Hope to get your service and the economic research personnel also to our department, because we need such service, because the practical experience is missing part. Thank you so much.
And
Thank you very much.
One thing, Doctor, I forgot to mention, I'm also a product of the University of Kelaniya, and I always happy to be back and be helpful in whatever way I can.
In which year you left Kelaniya?
That was 2000. I was teaching as well. I think
the Kelaniya, the commerce department.
That's right, Doctor. I was teaching in 2000. Yeah, in 2000, That was when Mr. Sunil Santha was the dean.
Yes.
And
I think your face is very familiar to me. I don't know whether you were with me because I joined.
I think we had a very brief spell.
Yes.
After we have some interaction.
Yes. So very nice to have met you, and you did a good service to the department. And we want to get your service in the future as well. Thank you so much.
Please call me. Thank you, doctor.
Yes,
thank you all.
Thank you very much. Yes,
all
your PA was so kind to me because I was always troubling her, and she was very cooperative. So thank you very much.
Thank you. And
Thanks
all the best for everybody. And we can be in touch later. Thank you.
Yes, and the other two lecturers are also Dr. Tishani and Dr. Samarakon, and I'm of course not doctor. I have not completed my PhD.
Okay.
I'm really worried when you address me as doctor. I don't want such things because which I don't have. I mean,
I think your sort of a caliber basically speaks more than the doctorate.
That is the way I talk, but I don't have a.
I'm sure.
That's the thing.
I'm sure the students are at very good hands.
Thank you so much. Thank you very much, and have a nice day. Stay safe. Thank you so much.
You too. Okay.
Thank you very much.
And I think.
Bye-bye.
Yes, please wait for a moment, doctor.
Okay.
Thank you very much, doctor. And we got a lot of information. It's a very informative session. So now we are ready to move to the thanking note. So the time is for the organizing committee.
Good afternoon, everyone. We have come to the end of our session, and I'm here to deliver the vote of thanks to all the dignitaries who have taken part in this event. I would like to thank our guest speaker, Dr. PKG Harischandra, for enlightening us with your knowledge. I'm sure today's session was full of knowledge and it gave deep insights into the topic. I would also like to thank all our lecturers and all the students who work hard to make this successful. And thank you everyone for presenting here. Thank you and have a nice day.
Thank you.
Thank you.
Okay, thank you very much.
Dr. Harischandra, if you don't mind, could you please send us the presentation?
Sure, yeah. I'll do. No issue.
Yeah, because that will be of immense importance to us. Yeah.
No worries. I'll email you.
Thank you so much.
No problem.
Okay, right. Have a nice day. Bye-bye.
You too. Bye-bye.
Thank you, sir. Thank you.
Thank you all. Thank you. Bye.